Good morning. Welcome everyone to this special event where we are set to take stock of the private equity venture capital industry landscape with the help of 15 plus expert speakers. We now take the opportunity to thank our sponsors, SN Capital, Shardul Amachan Mangaldas, Stakehold Capital, Cap Hive, Gaja Capital and Special Invest for making this event possible. We also thank our session partner, Chandriyok and Mahajan, for their support. I would now like to call on stage Mr. Shibulal, co-founder, Infosys and Innovation Family Office. I now request Mr. Shibulal to release the CD Day landscape with us. I now request Mr. Rajakumar to come on stage and receive the first copy of the report. I call Arun Natarajan, founder of Venture Intelligence, on stage to present the highlight of the report.
Good morning, and thank you for all you to be here nice and early, despite the Bangalore traffic, obviously. So it's our pleasure to have someone of Mr. Shibulal's stature to launch this report. Let me quickly present the highlights of this report, at the end of which I will have a QR code from where you can download this report, pretty much double-clicking on all the highlighted data that I'm going to present right now. Series A investments. Why is this an important number and why are we talking about it first thing in the day? I'm going to borrow the words of VG, CEO of Axelor, because I can't say it better. The total number of Series A investments represents a great barometer of the maturity of the startup funding ecosystem. And it is also a leading indicator of the quality and scale of the companies that are being built today. These are VG's words. Thank you, VG. So what does this barometer now tell us about the last 9 years of numbers going up and down Series A? If you look at it from 2017 to 2019, nice straight line up. 2020, the COVID year, Series A numbers start coming down. 21, 22, they skyrocket. And 23, they come crashing down. So point to keep in mind out here is that, we are 22, the funding winter had already supposedly set in the later stages, but Series A was still climbing and it's come down hard in 23. Some numbers typically have a lag, but keep in mind, the good news is that first half of this year, the numbers are inching up. These are projected numbers, and we should go back to the average of the last 9 years, around 166. This number also worth bearing in mind. Who are the most active investors at this stage? Peak 15 Partners, formerly Sequoia Capital India, is the most active in the last 5 years in Series A investments, followed by Axel India. Elevation Capital, used to be called Safe Partners India. Then the homegrown Bloom Ventures, Z47, which used to be called Matrix Partners India, makes up the top 5, and then there are other names that you can see. Let me move forward. This number and this league table does not stay the same. Right in 2023, these numbers changed, and Axel India became the most active in terms of Series A, followed by Bloom. And as you can see in the first half of 2024 on the right side, Bloom is kind of overtaken and become quite active in the Series A stage. They started life, by the way, as a seed fund. Talking about seed, this is the biggest catchment area for Series A investors. and clearly far more volume here in terms of number of investments that happen. Here we are combining all kinds of seed investments. These days there are new terminologies, pre-seed, seed, angel, and all of them put together. So these numbers include angel investments and typically micro seed investors, institutional investors. So that is what we capture here. I'll come to the funnel part towards the end. This is again the most active seed stage investors. So peak 15, thanks to its seed program called Surge. In the 5-year period, they were the most active. Bloom is right next, and Axel 314, India Quotient, and Axelar Ventures right there on the top. This is a very interesting slide in the sense of who are providing the Series A investors the right kind of companies that they can back. So of the kind of companies, the 48 companies that Peak 15 backed, how many went on to successfully raise Series A? So Peak 15 comes in at the seed stage. How many of those companies go on to raise the Series A funding successfully? So that's again the order of the kind of funds that are successful in graduating their companies to Series A. So Bloom Ventures is next, Axel India, Axelar is right there. So on the right side, again a nice deeper look into the data is a year-on-year breakup of how many of these companies. So if you take Axelar for instance, of the 21 companies, 4 got Series A follow-on funding in 2019, and then 2020, 2, 3, 8, and 2023, 4. So it's probably interesting to dive deeper. All of these details are there in the report with some notes as well. So this is my favorite slide. Remember, we saw an average of 600 plus seed deals for every 166 average seed investments. That ratio of 25% of companies graduating from the seed to the Series A, is very well represented in this funnel, VC funnel. So this shows we took around 4,000 companies which kind of received seed, pre-seed, angel networks, super angels as we call them. All of them put together, 4,000 companies we studied between 2015 and 2023, and found how many of these companies graduate to getting a Series A, right? And we gave them 18 months at least to kind of be ready for the Series A. So we eliminated companies that got funding, in the middle of 23. So of that 3 to 4, 6 companies, only 25%, depends on how you look at it, only 25% of those companies graduate to getting a Series A round. So this clearly shows the kind of filtration that happens, reflecting VG's words, of the quality of these companies that are ready to absorb this kind of capital. And from there on, the good news is that once this quality filter has been applied, the rate of success to getting a Series B, a Series C, goes up stage by stage. So 41% between Series A and Series B, and then improves to 45%, and from there 47% as of now. So this is something that is available with much detail inside the report. So folks can use the QR code right here, and we will have a banner also out there from which you can scan this QR code and download this report. So at this point, any feedback, etc., please relay it to us, and we will be happy to come back to you. So without much further delay, I would request Mr. Shibulal, because he represents probably the poster child startup, of the Indian ecosystem. And today, sir, there is going to be a lot of talks about startup IPOs, and who better, which other company can we look up to in terms of governance in the technology space that all of these startups are getting ready to emulate. So thank you so much, and I welcome Mr. Shibulal to stage.
Good morning, everyone. It's a pleasure for me to be here. Thank you very much for inviting me. So, my mind went back to 1981 when Infosys got started. I had gone home to tell my parents that I'm leaving a job. So I had already left one job. My first job was in government service. I was a public service employee with complete job security and quarters and all kinds of other things. That I left to join a private organization. My parents did not understand that. Then about 6 months later, almost 6 months later, I went back home and said, I'm leaving that. And my parents said, what are you going to do? I said, I'm joining a startup. The complete blank. Startup, entrepreneurship, all these things were not understood, even accepted in early 80s when Infosys got started. And of course, all of you know that the ecosystem was also not there. There was no funding ecosystem, there was no seed ecosystem, there was no venture capital ecosystem. None of that was there in 81. Of course, moving forward, many things changed. And after 2014, I have been involved in the startup ecosystem through Axelor, because Axelor got started in 2013. Operationally, they runs everything, but I do keep in touch constantly. And by 2014, I think entrepreneurship had become an acceptable word. In 1981, it was not understood, but 2014 it became an acceptable word. And today, I believe it is a respected profession. I think today, when children go home and say they are going to start going into a startup or become an entrepreneur, I think it's a respected, it is seen as a respected activity today. So a lot of things have changed over the last 40 years. As just mentioned, I think we have about 1,500 plus VCs, funding agencies, numerous angel syndicates. So today founders do have a choice. They have a choice in getting seed funding and other support from the ecosystem. And I've also seen in the last 10 years that the sectors have become very diverse. When 2014 Axelor got started, most of the application was in the e-commerce space. Mostly commerce, consumer commerce. But today that's not true. If I look at our own investments, it is in a completely diverse set of areas. There is a strong healthcare presence, there is a strong enterprise SaaS presence, there is a strong consumer presence. So the entire ecosystem has become very much more diverse. That also means that the funding agencies, the VCs and angels also have become more thesis oriented and willing to take bigger risks. I was just talking about space tech, right? So today there are people starting there are startups in the space tech area, which is probably very long term. Right? So all that has happened over the last 10 years. There are many businesses getting big, that is very good. And we are also seeing entrepreneurs who are much more experienced coming into the space. Probably in 2014, before that, we used to see a lot of college grads coming into the space. That continues. But today, you are seeing experienced professionals coming into the entrepreneurial space. So all those things have changed. And our ecosystem has become much more mature over the years. So one big area which we just saw was the Series A space, right? The number of companies who are getting funded in Series A over the last 5 years have actually remained same or it has come down. And in 2024, the number of companies which are going to get funded in Series A, I just saw it in 154, which is exactly the same as 2018. So the Series A numbers are not really moving up. And Ganapati has told me multiple times that that is one of the major milestones which a company should achieve. Because if you pass the Series A milestone and if you just look at the report, every other stage is almost 45% success. Series A to Series B is about 45%, 47%. Whereas the Series A milestone is actually the biggest hurdle for building value and building companies. So that's a very, very important milestone for the startups to cross. So it's interesting that I'm actually very impressed that when intelligence is bringing in focus and putting spotlight on that area. an area which we all need to think about and see how we can actually improve it. I'm a person who believes that whatever is not measured is neither understood or can be improved. So measuring that space and showcasing that space, putting spotlight in that space will make us understand the reasons why it happens and probably give us a chance to improve those numbers. So with that, let me thank Venture Intelligence for bringing out the report. Congratulations and all the best.
So we have the opportunity to put across a couple of questions to Shubhalal. So I will kick off with the first question. So a couple of more, because he has a flight to catch, so he should be leaving after this. So I requested him to spend some time with the panel, but after that. So my questions are, these days, startup IPOs are all the rage. The Indian market is supporting these startups, and a lot of them are gearing up. Some of them have already gone public. Now many more are lined up. This week Swiggy is filing for an IPO. What would be your words of guidance to startups as they prepare for the journey into the public markets? As a venture capital ecosystem, this is looked upon as an exit opportunity. But how should startup founders look at public markets and life beyond the IPO?
So actually, if I look at, reflect back on what Infosys did during the early years and during the IPO time, I think there was tremendous amount of importance given to governance, right? The proper governance being in place, whether it is about transparency. So, Infosys had this number of these catchphrases. So when in doubt, disclose. That is one of the important things which we used to think about. When in doubt, disclose. It is not the other way. You hide everything and you disclose when it is convenient. It is about disclosing to the shareholders early on so that the surprises are avoided. So when in doubt, disclose. Bad news travel faster, so make sure that your bad news is given to the shareholders at the earliest time. Governance from a board perspective, how to make sure that you have a diverse set of boards. So if you look at actually some of the failures, you can see that the composition of the board becomes extremely important. You make sure that you have a diverse set of talent in the board. Some people focus on HR, some focus on finance, some focus on governance. Making sure that there is a good balance between internal and external board members in the board itself. Making sure that that balance is maintained, making sure that you have an independent chairman, you have an independent audit committee, you have an independent compensation committee. So the list goes on. So the governance is a continuous activity. It is not a destination by itself. You have to continuously make sure that your governance improves and keep up with the global standards. That's the number one thing I can think of. Making, then the typical other things matter, making sure that the team stays together, making sure that as you become larger, the innovation continues. Execution is the key for performance, making sure that the execution happens. We always used to say that performance creates recognition and recognition creates respect. And respect creates influence. So if you want to have influence, you have to make sure that your performance is managed. Your performance is what gets recognized, and that gives you respect. And that respect in turn gives you influence. And Infosys also believed that 10% is strategy and 90% is execution. Again, the long-term versus short-term conversation is very often. Infosys always believed that long-term is a series of short-terms. It is not like you can say, I will do something 3 years from now. If you say you are going to do something 5 years from now, you still have to do quarter by quarter improvement in those parameters. So I talked about governance, I talked about long-term versus short-term, I talked about transparency, I talked about strategy versus execution.
Thank you very much, sir. Any questions? So as kind of wrap up. So one of the thoughts, if anybody has a question, please put your hand up so that I can notice. Otherwise, I'll go on. Sir, on being public in the US, being public in India, today a lot of startups are kind of studying home to become public here. So any thoughts from your side, and hopefully they also want to kind of go public overseas later, because Indian markets are the more receptive at this point in time. So any thoughts on balancing the two worlds, sir? Is there any difference at all in terms of how a company should look at opportunities to list overseas and in the Indian market?
See, most of the organizations today start day one being global, right? Because the market is global, the access to markets are global, funding is global, all those factors. Today most startups start thinking global on day one itself. Being listed in a market outside gives you enormous amount of brand visibility, it gives you enormous amount of access to capital and customers, right? Because there are still many Fortune 500 organizations which will hesitate to work with Indian organizations because of various reasons, whether it is legal, whether it is trust. There is some amount of reluctance from large corporations to take a risk with a startup from India. So that is one of the reasons you look at listing abroad and being abroad, because that gives them some amount of legal clarity as well as compliance confidence, right? So it's good at looking at both sides. But even today, I think for certain sectors like healthcare and all that, capital availability in India is very low. When you look at long-term capital, patient capital, Indian capital in my mind is low, because I think outside India there is availability of patient capital. So this is a sector-by-sector decision to take. If you're looking at a very long-term play, especially in a biotech industry, for example, if you are doing new development, new innovation in any kind of therapeutic areas and things like that, it requires very large, very patient capital. So that is not easily available in India. So that means sector by sector one needs to take a decision based on capital availability, based on customer confidence, based on talent availability and brand requirements.
Thank you so much. Any other questions? Do I see any hands? Wait for the mic, please.
Morning, sir. This is Kumran from State Board here. You mentioned there's not a lot of companies which has reached the Series A stage from seed stage. Is it because the screening criteria is not refined to the date in Series A, or because the startups have not refined themselves to the date to meet the criteria?
I think it should be both, right? Because it's not one way or another, it should be both, right? It is also, many of the startups may not have reached that stage, or the ability to take that kind of risk is low. So that is something which we just need to understand, why that number is low. It's not easy to just give an answer to that question. The number is definitely low and definitely lower compared with the international standards. So one needs to look at it and see what are the basic reasons. I'm sure both are equally.
Any one reason? I know various lot of reasons.
Why the number is low?
Sir, in my mind, unlike other markets, the amount of capital that is available exclusively for Series A is a variable number. Right? India is possibly one of the few markets where $300 million funds write 300K checks. That level of discipline is a question of maturity of the system also. So it's a function of the amount of stable capital available. You have seen the amount of seed capital that is available for startups from 2014 to now. It has definitely grown 8 to 10x. The amount of capital that is available post Series B used to be high, but predominantly foreign capital. That number has also grown in favor of domestic capital in the last 3 years. But if you look at the capital available exclusively at Series A, that number is a variable number. Once that pool grows, once we have some discipline, once founders have predictability in terms of what are the benchmarks for me to get there, which are the funds that are available for them to be interested in me when I get to a Series A benchmark. If that improves, I think this number should improve. Ideally, for our ecosystem, the number should be somewhere around 300. We are still languishing between 150 and 160. When that happens, I think it will go.
But I think also we were just talking about it 3 minutes back. Outside India, most of the funds are narrowly focused. They don't usually, the flexibility is low for that. Because I think the LPs hold them responsible for a certain activity which you have articulated, which means the funds flexibility to move outside that guardrail is low. Whereas in India, I think the flexibility is very high. So any fund can move this way, that way.
If there's no further question, I would thank Mr. Shipalal. Sir. Any other questions? Yeah. This is the last question.
Hello. So I think we showed very nice that funnel about 25% for you also mentioned about it. I was just curious to know, is this a standard across the world or is it only India specific, and if it is not a standard, what are the numbers are there for US and other market if we have any data?
Probably let VG add to this, but these numbers tally quite well with the overseas, the 1 in 4 numbers. I don't know whether VG has looked at international data, but to the extent we have, it's roughly tallies with the global trend. Anything to add, VG? Thank you so much, sir.
Thank you.
As we get started with the inaugural panel titled PEVC in India Unleashing the Next Wave, we welcome on stage our speakers of the inaugural panel, Manav Nagaraj, partner Shardula Merchant and Mamalas, Rajakumar, founder and managing partner SM Capital, Ritesh Banglani, partner Solaris Ventures, Tarun Dua, co-founder and managing director at E2E Networks, and Asam Shukla, founder and CEO of Capital. founder and CEO of Tata. I take pleasure in introducing Manav Nagaraj, partner at Shardul Amachan and Mangalas. Manav Nagaraj is an equity partner of the firm and has been in practice since 1999. He has experience and expertise in several local and international transactions in private equity, venture capital, mergers and acquisition, fund formations, and other transaction advisory matters. He has advised global funds, financial institutions, family offices, promoters, and corporate across sectors. Manav has a particular expertise in impact and social investing in India and has also worked extensively with foundations and philanthropic organizations in grant making and patients capital social sector investing. Over to Manav and the bank.
Thank you. It's always a hard act to follow a legend like Mr. Bilal, and we try our best. We have a stellar panel assembled. I will request the panelists starting from Assam to briefly introduce themselves before we get into the discussion.
Thank you, Manav. Good morning, everyone. My name is Asang Shukla. I run CapHive. We're a technology platform for private capital markets, which essentially provides SaaS platform for private market funds and technology platforms for running multi-party transactions. Prior to this, I've been a banker for almost 20 years. So look forward to the discussion.
Hi, I am Tarun Dua. I am the founder of E2E Networks. E2E Networks is one of the homegrown cloud infrastructure players in India, where we have built an engineering organization where we have written all the typical microservices that you have come to expect on any infrastructure cloud, and we directly compete with the global hyperscalers in terms of like features, performance, reliability, scalability, and everything. My background is I did computer science from NIT Kurukshetra almost like 23 years back in 2001, and I worked for a bunch of startups, majorly in India, spent a small amount of time in the US, and currently E2E Networks is very focused on AI compute infrastructure. We were the first ones to start doing cloud GPUs in India way back in 2019. And we were the first ones to bring in H100s from NVIDIA in India, like as far as back as like November 23. And hopefully we'll be the first ones to bring in the H200s and all the latest generations of GPUs. And we have built the software infrastructure around the AI infrastructure to enable data scientists and AI ML engineers to do their work faster and cheaper and better. Thank you.
Hi.
I should come to this pause for a minute. I don't know who else is seen, but today Tarun and E2 is featured in today's Economic Times, so it's very topical.
Hi, I'm Ritesh Kamlani from Stellaris Venture Partners. We are an early stage venture firm that invests in seed and Series A rounds of technology.
I'm Rajiv Kumar, founder of Ascent Capital. Ascent is a mid-market private equity firm. And before coming into private equity business, I used to work in SEBI and started a career in Indian civil services.
With that, we'd just like to my first question is to Raja. Raja, you're probably one of the few people in India who's had such a rounded thing from your career in the civil service to SEBI to being, setting up a fund, being an independent GP, seeing investments and seeing exits. So, in a panel, the theme of which is PE and VC unleashing the next wave, can you just take us through your journey in India and how you believe, using the benefit of that hindsight, if you can share some light on what you think would be the way forward?
Thank you, Manu. Perhaps I need an hour. I'll try to be very brief. So, as all of us are aware, India adopted free market reforms from 1991. And SEBI, one organization which is instrumental in creating a phenomenal reform very successfully. And I happen to be one of the few civil servants. This very small team in SEBI those days. So we got trained in SEC Washington, and we went on implementing reforms in this country. And I'm very glad to say that perhaps no other regulatory body has implemented such successful reform. Today, Indian capital market infrastructure is one of the most efficient and robust infrastructure, and I'm very happy that I was part of it. So, since then, if you look at, we have been seeing market from 6,000 Sensex to 83,000, right? And it has grown in quality and quantity. I mean, number of investors, and so we have, perhaps we can write a book how we fought in the early days to make people accept, regulatory reforms and transparency, right? And when we went to inspect Mumbai Stock Exchange in the year '93 to investigate Harshad scam, that was the first ever inspection of BSE in 150 years of that institution. Okay, and then we created NSE to tame BSE, and that is the history. Why I'm saying all this is a lot of efforts made by early leaders, early chairmen of SEBI, who were instrumental in creating this great institution. So now we are enjoying great liquidity, right? And abundance of liquidity. Often questions are asked, is it sustainable? And I think I've seen markets for a very long time. I believe that this liquidity is sustainable, and there may be small corrections, but this will continue. This is happening basically because of the mindset change of new generation of Indians. I mean, they're in a hurry. We funded Big Basket. They used to deliver in 30 minutes, but the young generation wants in 10 minutes. And quick commerce, nowhere in the world it exists, but in India it has got a scope for it, right? So everything they seem to want in a hurry, and they want to live long. They will live long, more than 100 years, I think. But they don't save. They would like to invest. So they've come in a big way into Indian markets, and there is a mindset change. So this will continue. And also they are short term in their outlook. They entered in such big way into derivatives markets, and they made India's NSE as the #1 derivatives exchange in the world. And 84% of equity options trading in the first quarter of this year in the world belongs to India. So a lot of excesses happened, but this is the mindset of the new generation of India. So this liquidity will continue, and because of that, markets will do well. And I would like to rather quickly talk about how evolution happened in venture capital, private equity context. That's what we are here today. So late 90s or early 90s, like Mr. Shubulal mentioned, there were no risk capital pools available in this country. I used to be one of the regional directors of SEBI. Those days, 23 stock exchanges. Even for 5,200 crores, you go to IPO. I personally cleared about 1,100 IPOs out of 6,000, 8,000 listed companies in those days. So that was the market. And now, the early 2000 onwards, the venture capital pools are available, mostly backed by foreign investors. And cutting the long story short, as VCs, then and now, we learned a lot, we are still learning, that we have invested and we were not able to exit, and there are no distributions. And failure teaches a lot, and VCs learned a lot. So what works in India, what will not work in India, and that is a continuous process. And also the entrepreneurs, they thought, when they are running a startup, they thought the valuation is linear. I mean, they raise at X value, then 2X, then 5X, whatever it is. It took a long time for them. Valuation is not linear. Surveying the company is more important than playing the valuation game. Second important thing is again a mindset change that happened in entrepreneurs. Is about they were very touchy about the stake they own in a company. It took so much time to say it's not the stake that is important, it's the value of the stake. The growing the pie is important. Okay, this kind of mindset change that has happened. The last word to say about venture capital productivity evolved. Today they have 1400 to 1500 AIFs. So we as early venture capitalists, we struggle a lot to keep this asset class less regulated. The venture capital is basically a LP-centric game. It exists for them, by them, of them. And it is a private affair between LPs and GPs. That's the way this asset class works. That's why for a long time in SEBI we said it's only a light touch regulation that is ideal for this asset class, not the other way around. So we have to see in India, unfortunately in my view, that too many retail investors jump into venture capital industry. I have doubts that they can wait for 10 years to 14 years. It's a patient capital, like Mr. Gurul said, it's very important. So we have to see how it is going to play. But like so many startups fail, even VCs fail. So it is not like we have seen down the funnel that so many companies really don't know what happens. So the last word I would like to say in the interest of time. So we have evolved a lot in our asset class, but still we are not good at handling failure. The VCs and also the founders. In India, downsizing, cutting the burn, writing off the investment is a stigma, firing the employees is a stigma. Still we don't know how to handle this. So I think we should learn very quickly that we have to start, accept the failure, write off and move on. And also I see in the press, there are a lot of interesting press channels we follow, right? So everybody writes a particular company how it has failed. I don't know, for my mind, why failure is a news in our industry. Failure is so common, like traffic in Bangalore, and it happens, right? And so I feel failure is not a story at all. I don't know why we are writing. So I think overall, to sum up, that we have come a long way. The capital market evolved. It is a perfect market. It has delivered returns, best returns in the world on a long term of 20 years, almost better than the US market, and the best emerging market is the Indian market. And venture capital ecosystem is evolving now. I think I'll leave it to the others.
Thank you, Raja. I think that sets the tone. I request the audience to please note down any questions they have. We'll have a separate Q&A in the end and we can take it forward from there. But I just want to pick up from what you said on the increase in the number of investors coming into fund. And I think, Asan, you with the benefit of the CAP platform, and what are you seeing? Because there's a change in the type of funds that are being set up, from smaller LP pool to funds which have large number of LPs from 50, 100. Now of course there's a 1 crore limit. So so there are more people who are coming into to be part of the fund ecosystem. What are you seeing in relation to some of that, and can you please share some of your experiences in that way?
Sure. Thanks, Madam. You're right. I think it's a very interesting trend. Raja referred to the meteoric rise of funds in India, and I think we all must thank, by the way, the work that SEBI has done to kind of create a very strong framework. So thank you for that, Raja. But I think we all beneficiaries in some way in form of that. But the large rise in the last few years in India, and actually seeing this increasingly through funds around the world as well. It's linked completely to the rise of wealth and the rise of family offices, rise of ultra HNIs, and the natural extension, people wanting to participate early in the game, come in at the ground floor rather than waiting for the companies to the public markets. And you're right. I think 5 years ago, funds were typically clubs of 15, 20, 30 investors. More than that used to people used to work at that. Today, routinely, like I said, we run SaaS platforms. Fund that we see clients anywhere between, I think the smallest maybe about 60, 70, largest goes up 1,000, and the median being somewhere between 200, 300 investors, and it's only rising, right? I think if you look at just some statistics, total private market funds AUM, which is in the AI context category 1, category 2, is approximately about $100 billion of commitment. If you look at exposure to private markets globally, estimates vary anywhere between 12 to 14 trillion dollars. We talk of capital raises. We pulled out this stat for the top 50 private equity venture capital funds, and that's really more private equity when you go to the larger volumes. Just the top 50 in the last 5 years raised approximately $2 trillion of capital, and this is just in the last 5 years. Range, of course, largest being, of course, Blackstone, about $125 billion. The smallest was about $16 billion. Median, is somewhere in median was about $30-40 billion. The largest Indian fund ever raised has been recently Kedar at about $1.7 billion. So we are, this trend is only increasing from here. So I think one key question which we've seen funds ask, and I think that's really stemming to a lot of the questions around SEBI coming in and asking lots of questions, people coming in there. So the question is really, if this trend is here, it is going to continue. There are going to be more complications in terms of people asking to co-invest, multiple structures, funds set up in India, GIFT City, Delaware, Mauritius, each fund structure has multiple things. So the question is, how are funds themselves prepared for it? And we are actually seeing that conversation that, how are you prepared to handle more number of investors? Be ready, there will be more regulation, there's no question about it. So how are you ready to prep up for it? The requirements that LPs have, the requirements that GPs have. So to manage all of that, I think that's kind of the next set of conversation. We're seeing a lot of forward-looking funds kind of engaging in that. And of course, selfishly from our perspective, we love those conversations because we fundamentally think the moment it's become a multi-party relationship, technology is the answer to kind of solve a lot of these questions. Very less fundamentally technology is being built exclusively for the needs of private markets. And we think there's going to be a lot more headway and a lot more conversations like these which will kind of propel things forward.
Thanks, and I think that's an interesting segue to if I could go to Ritesh, because the as Arun mentioned earlier also, the Indian markets, the move to come back to India just because of the attractiveness of the Indian markets. Now, traditionally, venture capital funds, especially early stage funds, their exits have been more in the form of secondary sales, in the sense that you get a bulge bracket PE firm or somebody else who come in, do a cap table cleanup as part of a larger investment, and then now, I mean, some of your portfolios have also, attracted attention in the capital markets and have listed. But do you think now, even for an early stage investor, exits in the form of a primary market exit is a viable option, and what are the trends that you are seeing on that?
So the short answer I would say is absolutely yes. I don't think the challenge ever was whether there was interest in the public markets in startup stocks or technology stocks. The challenge was that the financial performance of the companies wasn't enough to be able to list. And that, I think, has been the biggest shift in the last 3 years. That companies have both become large in terms of revenue scale and delivered profitability. Some after the IPO, but some at the time of the IPO, to be able to convince the capital markets that it's a viable investment option. So I think the belief, I'm sure Raja can attest to it, we have, in the industry we have all had the belief for the past 50 years that public markets are the right exit mechanism for startups and technology companies. And I'm very glad that that tap has opened in the last 3 years. And that's only, it's not because the Indian investor has suddenly realized that there's a great asset class. I think it's because the companies have performed to grab the attention of the Indian investor.
Before I come to Tarun, I just want to pick up Tish, to just carry on from what Raja said earlier. That the regulator, when they were there, the intent was to make it light touch. Just given the flurry of interest now, is there apprehension that with more Indian companies looking now to list in India, and including companies that have value in India but cap tables outside India, will come back into India with the view to this, that there is some apprehension that the potential of the light touch could actually change to, protecting the retail investor, and in that zeal to reduce flexibility.
Yeah, unfortunately, it's not only an apprehension, it is slowly becoming a reality as well. That the regulatory regime that we had been used to, which was a light touch regime, has started to get tightened in the last, I would say, 5 years. We understand where the regulator is coming from, that slowly retail or retailish capital is flowing into this asset class, and it is the regulator's mandate to protect the small investor. However, at least my view is that can be achieved by increasing the limits on who can invest and who cannot. So today the limit is 1 crore. If that is attracting retail investors, I think it's totally fine to raise the limit to 2 crores, 3 crores, even 5 crores. What the industry is more apprehensive of is meddling into what should be a private arrangement between the investor and the fund. So what terms you can set between yourselves? Can you co-invest with? Can you offer co-investment to your LPs or not? Whether whether you offer different terms to different classes of LPs. We have found that level of more granular mandates by the regulator, which we think will probably reduce the attractiveness of the industry and the flexibility that fund managers have to structure the funds for the best possible returns for each class of investors.
Rajan, I will come back to you on that. I just want to get Tarun. Tarun, you have a unique experience in actually looking at the markets from a very deep focus, just given your journey. If you could share that, both from an SME perspective and then quickly moving on from an SME to a main board, which is what your story is. So if you could share some of your learnings on that, and also what you see, are you going to see increasingly companies following a similar path, that you would first look at an SME and then graduate, for want of a better word, to the main board, or is the main board itself something attractive, or is it largely going to be for investors, just a secondary exit? Some thoughts around that.
Sure, Manu. So, like, lot of interesting ideas. So I'll try to kind of like sum up my thoughts over here. So one is, of course, that the availability of capital, despite all the hype we see in the news, is like quite less in terms of like early stage in India. So like Series A itself is 25% of seed investment. So which means that like in the private market, the private markets are like relatively very, very small. Now, public markets are probably like 10x larger or 100x larger, but they're larger by quite a wide margin. So, which means that like for the other 75%, the people who didn't get to Series A, people like us, like that's a viable alternative. So that's the way we looked at like going to the SME main board. Like the thought was not that like we are offering any sort of exits to anyone. Like even the investors who were there, like when we asked them that like, can you sell some of your equity? There was a kind of great deal of resistance over there that like, okay, why sell now? Like the journey ahead is still very long. So it was only for the purpose of like making things possible that like some of the investors like cooperated in terms of like, yes, like let us sell something. Because ultimately there is a long journey ahead. Like yes, I agree that like entrepreneurs should kind of like dilute to create the value. But on the other hand, like if you're looking at a long journey ahead, then you have to like do multiple fundraisers. So for that purpose, like the entrepreneurs also have to protect the interest into the company of like both the founders as well as the early employees as well as the founding members of the team. So from that perspective, of course, like the equity needs to be protected, like while going to the SME exchange. So in a way, like is SME exchange becoming a viable Series A alternative? My answer to that would be yes. Now, which means that like, see, the private market asks for a lot of signals. Now, in the venture world, even after like, so a lot of people have hacked the signals, especially in Bangalore. Like, okay, here is a signal list of 40 things that you need to do like a Series A, so which means that like a lot of people would hack those signals, and the old boys clubs, the alumni networks, like they would all help you. Of course, there is a part education and a part of like attitude of like, yeah, like we need to get all these signals done, and then the Series A happens. Similarly, in the public markets, like again, like a lot of investors look at a lot of signals, early signals, but ultimately it's the gut feel. Like where people invest, where people don't invest. It's not possible usually for an entrepreneur to sway the person sitting on like a pile of money whether they would invest into your business or not. Like you as an entrepreneur believe in your business, but for an investor it's a portfolio approach. Now the SME market in India, again, it's like it has deepened more recently, like where like a lot more entrepreneurs are coming in. When we went to SME, like we were like kind of like early movers, forced by the shallowness of private markets, and the shallowness of private markets will force a lot more entrepreneurs to go public early. But there is no sense of looking at that as an exit for entrepreneurs. The entrepreneurs have to look at their journey like on a 10-year, 20-year, 30-year level, especially for their companies. Maybe not personally, like most entrepreneurs like may not have a 30-year journey planned ahead of them, but like the path would be maybe to professionalize the company. So what the main board is looking at separately from an SME is that like the main board is again like looking at like growth stage companies similar to like a Series B or Series C or Series D and other growth rounds. And of course, there is a similar type of graduation of investors. You are dealing with like several classes of investors. So the journey from SME to main board, like again, it's automatic in the sense that like if you go to the SME, the criteria of migrating to the main board is not super hard, which is a great thing, and SME board acts as training wheels for companies to kind of like migrate to the main board. So it's an attractive option, and it has recently become far more attractive because a lot of public market investors have realized that like look, there are going to be a lot of diamonds in the rough that you can explore on the SME board, and when they move to the main board, then the bigger investors would kind of like discover them. And it's becoming very, very similar to the way the private ecosystems work in the VC world. So there are quite a few parallels. The major difference being that like the public markets are far bigger, far deeper. The signaling criteria are far more diverse. There is a lot more diversity, and there is of course the element of choice. Like so, people have their own themes. So the themes are not being dictated by like GPs sitting in the developed markets and thinking super theoretically about like how to look at entrepreneurs in India. The entrepreneurs in India, like their goal is to run their companies. Their goal is not to meet the signaling criteria of GPs sitting far away from India. So ultimately, like a great deal of leverage has to be given to the GPs in India for all the funds, both in the public markets and the private markets, to kind of like make a lot of bets, fail. Of course, patient capital, yes. Entrepreneurs, all of us like need to be more, conscious of the amount of time we are spending, and the capital, of course, needs to be patient. And in a way, by definition, the public markets are not like really patient capital. So some of the funnier conversations that I have had would be that, yeah, like, look, we are very, very patient capital. We almost like look at the companies for like 6 months before we invest or 1 year before we invest, and we stay on for almost like next 2 to 3 years. So, So yes, the definition of patient capital definitely changes in the public. So, but then the only worst thing about kind of like people looking for certainty in the investment community, only thing worse than that is the entrepreneurs actually offering that certainty. So yes, like we as entrepreneurs definitely need to highlight all the risks, both in the private as well as the public markets. And again, very similar world. Like, so too many parallels to say that like this is better than the other or that is better than this. Like I don't want to say that.
There are two things I want from what you said that I want to pick up on, and also I'm going to come to you in a minute. One is just immediately before a company gets to the exit, you especially on your platform. So I'm just going to give you a minute to think and gather your thoughts on that. But coming back to you, Radha, you have been a GP and also an independent GP, right, in India for so long. From what Tarun was saying, that GP has a responsibility to the LPs and takes the companies, and how do you believe that? And from your learnings, right, has the role of the GP changed? Are they now looking at something more than just being there as a bridge between the companies and the LPs? How are you seeing that evolve?
Thank you, Madam. As I said, GPs exist, they are basically actors directed by their LPs, and the kind of focus, the kind of style of investing, and the kind of returns that they are chasing, the kind of sectors and all that. So increasingly actively monitored and directed by the LPs. And GPs become, over experience, they become really exit focused, which is a good thing, that only can sustain this business. And thankfully, the evolving ecosystem, for example, even the founders, now we are dealing with serial founders, relatively easier to work with because they understood the venture capital model. They clearly knew that it is a contract marriage, and VCs typically talk about exits before even investing, right? And
I'm sorry, I didn't pause you. I really like that word, and I'm going to steal it and use it without attribution.
Yeah, please. So I say that the easier to work with the serial entrepreneurs, and fortunately many are the serial entrepreneurs starting new businesses, which is a good thing. And also the range of opportunities, though earlier we figured out only few sectors can actually deliver the expected VCP returns in India. But the range of opportunities, it's very exciting. Some of the audacity or the braveness of the entrepreneurs to get into, such startups in space, in drones, in deep tech, and clean tech, and of late. While AI is again a buzzword, everybody jumping in, I think AI services will be a great opportunity for Indian investors. The range of opportunities have increased. So, for the first time, we are observing as a senior player in Indian PE market. For the first time, we see that the entire food chain, from angel funding to early stage to growth capital, which was a gap for some time, which is available today to the IPO. For performing companies, for the founders with a larger vision, this is the perfect time. In fact, in Indian market has not been easy even to invest. Forget about exiting is very difficult, but investing was also not difficult. But it has become more difficult now because it has been a market for the entrepreneurs. Better it that way, they're able to pick and choose. They can raise capital as long as they perform. Even public markets are increasingly looking at new generation companies. Very glad to see that this is sustainable, and this kind of 20 billion to 40 billion per year looks like possible.
Also, I think I've given you enough time to. as CapHive, one of the things I'm sure you're seeing is a lot of pre-IPO transactions, secondaries, and how are you seeing the trends and what's been happening? Especially, you have deep insight just given where you sit in relation to this thing. What has been happening? What's the thought around it? Why are these transactions happening? Typically, what are the kinds of funds that are looking to come in and go out at the same?
So, we just did our broadly in two parts, right, in terms of the entire pre-IPO kind of activity. There is one kind of small set which is, till recently was largely dominated only by NSE, which is kind of like the public-private companies, right, which is kind of a genre. It's still private but deemed public companies from a regulation perspective, and shares are freely traded, and that kind of in recent times, of course, Swedish kind of rule the market there. So that's kind of one small segment. Purely from our perspective, we don't focus on that segment. It's kind of a little gray of regulations, and but it's, if you see the interest there, it's largely driven by large number of folks seeing an opportunity to come in, get allocations, which they find really hard. I mean, look at recent IPOs when the markets are good, getting allocations is impossible. So anything they can get their hands on earlier. So that of course is a fairly active pre-IPO or grey market, as that's called. Right? So that's one segment. The second larger segment, which I think of course has been muted last 2 years with the whole kind of chills of the funding winter, but starting to pick up, and it's been a significant trend. In other markets, particularly US, right? I mean, if you look at that, at least directionally, India is very different, but at least directionally, it's a nice kind of headway. Is that the number of participants as the company matures, right? So, companies kind of have gone from maybe, let's say, Series B, C, D. So they've come to some level of maturity. They're not of the level of predictability of revenues or profitability that they're not ready to get to the market. And for a large number of maybe founders and some of the large institutional shareholders, they're happy to say, hey, listen, let's wait for another few years before we get to the market. Right now markets are kind of what they are, but they are also going to go the other way. We think we like to continue to build for the long term. At that point of time, there are a lot of avenues which are now kind of coming up. Again, going back to a similar point of large number of family offices, large number of specialist secondaries funds, continuation vehicles, co-investment vehicles. It's been a very large, the secondaries market globally, just secondaries funds, is now an annual $100 billion of volumes. And it's rapidly grown. And this is not just, by the way, for companies, particularly for funds themselves, right? I mean, VC funds themselves are becoming long number of years.
It's coming into India as well, that same trend?
It's starting to come into India very, very significantly. We're seeing a lot of specialist secondaries funds talking actively of raising capital for India, and of course, a lot of them are increasing allocations. And also giving up, so if you look at, I'm sorry if I'm doing too much statistics, but I love these numbers because it's kind of gives some insight. So if we looked at the top 300 private companies in the country, and with the bias towards the new age, average number of investors, which is a combination. So institutional investors, the median number is about 23-24. Median number of angel investors 26-27. So we're talking a median number of about 50 investors, and we're not including employees, ex-employees, which goes into hundreds over here. Now a lot of them are, so leave aside the very large institutional investors, they take care of themselves and they generally come longer. A lot of the investors who come in early, right, Series A guys, employees, they do want to see some money out. And I think that kind of a construct of, it's loosely called private IPO, not that term too much, but because it's companies and founders to control the process and say, hey, let us allow an opportunity for exit for a large number of my early backers or small shareholders who do not have avenues like the large funds themselves, and bring in some of these slightly more passive pools of capital, back the journey, have continued to control, but I think it's very important for founders and large funds to continue to control the cap table, right? Because you are private for that reason, right? So you don't want to be held with whims and fancies, you do want to build for the long term. So you say, I still want to control that. I want to be able to tap into all these pools of capitals which exist at different parts and create a framework. I think so that which is kind of, we're starting to see a lot of conversations, a lot of transactions happening there.
I'm mindful of time and I do want to leave things for the audience, but I have to. How do you get companies ready to, from an early stage to a situation where they are ready for exits, whether in the form of a secondary exit where a larger investor comes in, or whether in the form of a pre-IPO or actual market exit. And I'll come to all of you in turn on this. And Mr. Shibulal earlier said that one of the things that they focus on is governance. Now, governance is more than just compliance, right? So, how do we get companies ready, especially the role of an early investor? Because we hear it and we know it that an early investor brings more to the company than just money, right? In addition to credibility, they also bring a lot of processes and so some thoughts around that, please.
Yeah, good morning. This is a very apt question for the venture PE fund. The first and the foremost, they have to figure out what kind of exit they are getting ready to, right? If it is an IPO exit in the main board, if it is an IPO exit in a SME platform, different criteria. The threshold required for making an IPO in the main board is going up. It needs certain critical number of top line and EBITDA, predictability, and revenue growth quarter on quarter, and different size, different criteria for different sectors. Okay, unfortunately, many companies are not really eligible to go to the main board and provide an exit. So, this is a critical decision you have to make. Like when you are going directional in a particular side, you should know where you are going. Because VCs, PEs typically they enjoy their rights, they hold convertible instruments, and when they are getting ready for IPO, they have to give up everything. There is no overhang on equity, and you're like any ordinary investor. I mean, moment you give up and go for IPO, and IPO won't happen, you can't get back those rights again. So you have to be very, very clear about that. And fortunately, companies who figure out that they are eligible to make an IPO, then they are able to get a lot of professional services at least 18 months before, and add new people to the board, practice better governance, and so they are practicing it. And we are aware some of our companies can make an IPO. And fortunately, there are another mode of exit that is one should really avail of. Is the pre-IPO exits, large HNIs, large family offices, having made huge returns in the Indian public markets, which are at the peak valuations now. They are very open to buying interest in the large companies, not the VCPs. And we are taking the chance, that window is a wonderful chance. And also, like some of my fellow colleagues mentioned here, the IPO exit is preferable because you get a lump sum exit, you get a much better valuation, because selling to a strategic is relatively difficult, where the buyers are so discerning in such long periods of due diligence. And after the deal is agreed, after many rounds of negotiation, then lawyers and then indemnities, and in India nothing is certain.
I was waiting for when that is going to come.
I mean, so the buyer's lawyer and our lawyers, they go on for many sessions. And so, I mean, the point I'm making is, this is a good opportunity for Indian GPs to realize exits through IPO, pre-IPO, and that will sustain us actually. And more exits means more you're proving the model of Indian VCs actually.
Ritesh, anything on that? I have another related question, so Ritesh will continue this theme.
So I'll pick up on the other question you asked, Manav, which was around where else do PE and VC investors add value beyond the capital. To be honest, I would be very happy if my industry didn't add negative value to startups. And unfortunately, so I did a little poll of about 50 senior entrepreneurs a couple of years ago. And I asked them, what do you want out of an early stage investor beyond capital? And the number one thing that showed up on that poll was, don't be a jerk to me. So I think we as an industry tend to overestimate the value that we bring. I don't think the value is zero, but we don't add value in any of the factors that matter the most. Where we do, I think, are actually able to generate value is in governance processes, in board processes. We are able to create good finance functions within our companies that are useful. We are able to help them fundraise. We are able to help them hire leadership. But in all the things that matter the most, which is proving the product, proving the go-to-market, proving scalability, proving profitability, I think it's really the entrepreneur and the management that creates that value. So I just want us to have the humility to accept that.
Thanks for being so candid, Hitesh. Before we get into the last thing, I think just want to look at some of the international trends and how they are impacting. You pretty much compete with the biggest names in the world. Are any international factors, not from a product and from your services offering perspective, but more from an Indian, where the ecosystem is on the PE and VC space, and also you can pick up on that as well. This is an election year in the US. There are interest rate movements in the US. Do any of those have an overhang here? Is the saying true that if the US sneezes, India catches a cold? Is that likely to happen?
I think more recently we have seen like a sort of delinking of Indian sentiment from sentiment outside. So broadly, I don't think it is like that true anymore. That like whatever is happening in the globe, unless it is like things that really impact India, like the price of oil or availability of AI chips. Like I think like the other factors are like less and less likely to affect India now.
So I think mixed answer, unfortunately. I think there is clearly the amount of liquidity which is coming into India, domestic liquidity, is providing a lot more runway. I mean, we've seen that in public markets, right? If I go back to my ex-banker hat, right? 10, 15 years ago, you could not price an IPO, you could not do a deal without a large, either a global public market investor or a large global fund, with public or private. That changed, right? 4 or 5 years ago, you started kind of, the leaders were the domestic mutual funds. Are we there yet on the private side? Perhaps not as much, but significantly so, right? I think, especially in the early stage at least, I think all the way to Series B for certain, the 1,000+ Indian funds have enough and more liquidity, and I think there was a point earlier made that they're actually a lot more closer to the ground. They can take calls and run there. We go to the larger value transactions, anything $200 million, $2 billion kind of thing. That really is still driven by the global sentiment. So if there is a decline in sentiment for India, or for example, if the market dynamics become more favorable to the US as it did in 2010-14 level, the funding to Indian market will definitely see an impact. But I think as we see today, I think at least small time, election years, geopolitical events are important, but as long as they're remaining kind of ring-fenced, I think markets are a lot more mature and a lot more liquid to kind of not let those be more than -3 months.
I'm just going to take a last question to the panel before we go into the audience. And Raja seems to have this innate ability, because of his experience, to predict my next questions. And he did mention the protracted negotiations. I think this question is to everybody, and we'll keep it quick. While there's been a spurt in deal activity in the last few years, there's also been a situation increasingly where transactions are taking fairly long to conclude. And there are several, people like me maybe to blame, but how, from your experience, how can all of the players in the transaction ecosystem, investors, entrepreneurs, consultants, lawyers, bankers, auditors, everyone just make the process a lot simpler?
Thank you, Manav. No, this is a sign of maturity. Both sides employ smart lawyers, and so the deals take a long time, and ultimately the founders and the VC involved have to decide what is important, what is not important, and right. And it typically, in a real sense, depends upon the balance of power. I mean, who needs whom most, right? And the founder, the cash is running out in the company, and you want to take the capital, and then the founders are willing to, give up the rights, whatever it is. And sometimes, in a worst case, the rounds happen, but happen with extreme terms like liquidation preference, expiry. This is a very dynamic. I think nowhere else in the marketplace such a dynamism exists, where the reality strikes the founders and the VCs, and this kind of, because every year is a new market, and with so much of difficulty, you negotiate the terms and sign up, and the validity of that is only for next 12 months, and when you are raising new round, all the old covenants fall away and then enter into new covenants. So this is a journey of raising capital. I mean, it is what is the game here? The game of VCs and founders is scale up. Raise capital, address the market, find the market, change the model, and the growth. Because without that, no value created for anybody. So, I mean, this is a very purposeful kind of behavior between the investors and this thing. And thankfully, the intermediaries, the best law firms, are very well experienced about that. And but going forward, when there is so much of availability of choice, okay, and the negotiations take time, experience. Of late, especially, we are figuring out what to do with those investments which are not really scaled up to give us an exit. So those situations, you just want a different set of rights, and that is the experience. That's why we are negotiating hard to have those kind of rights in a less favorable situations.
Actually, I have a little bit to add. It is a consistent pain point for me. I have never seen a situation where both parties want something so desperately but have never been able to get it. I've been a VC for 18 years now, and have never seen a situation where at least one of the parties says, okay, let's take 6 months to complete this one. Everyone wants to get it done within 30 days, and yet I have actually rarely seen even a seed round conclude within 30 days. At least I'm growing relatively cynical about the rights, because when it's time to enforce the rights, like Raja said, it is really about a starting point of a new negotiation. Whatever you write on the paper just provides you the baseline to negotiate at that time. And I'll give you an example. I have never signed a term sheet that did not have liquidation preference. Yet, I have never been able to enforce a full liquidation preference. This is in a scenario where 80% of our companies fail. 80% of our companies actually don't give capital back or just give capital back. And still, despite having that right, I'm talking about a sample set of roughly 130 companies over the last 18 years. And I have never been in a situation where the first 1x of the capital goes back to the VC firm. So I don't know why we spend all that time negotiating those deals. What I would really prefer is a standard set of docs for the industry that is fair to both sides and that you can sign on and wire the money within 30 days. But somehow it hasn't happened so far.
No, I agree with Ritesh. So there is nothing more important than speed, especially for entrepreneurs, because the market opportunity, the earlier you get into an opportunity, the more time you have to go through making your mistakes, learning from those mistakes, and fixing those mistakes. So as entrepreneurs, we like to get back to business. So fundraising is not our primary job. So basically, if we end up spending months and months on fundraising and negotiating the terms, that doesn't help the business at all. So that's a net negative value for any company.
Manav, I think just going back to my banking days, I think I'll just say that the most important part there is the lawyers. Right? I mean, bankers everything else kind of moves aside. So eventually lawyers on both sides, eventually people respect. So I think, and I don't say this lightly, I think we used to really spend a lot of energy with clients saying that, listen, make sure you have a good lawyer, right? And both sides, even actually the investors that, listen, if you have a good commercial lawyer, at least potentially 1 month of the process is going to be shaved off, and you're not going to spend time on inane things, Ridesh mentioned. Sometimes you kind of go theoretical. There are things, these are very important pieces of paper, but I think lawyers, a good quality lawyer really helps through the process. And on a light note, I wouldn't be a good bootstrap founder if I didn't advise a little bit, but at least on the transaction process, honestly, have a conversation that can technology make things better, right? And you can't negotiations and underwriting thesis, etc. But we've seen literally multi-party execution processes become crisper from 6 to 8 weeks, get done in under a week. By just making a lot of things smoother, faster, better. So I couldn't resist that. Sorry.
Round of applause for this panel. These are very, very senior people who have taken time off from a working day to come and spend time with us. So thank you so much. I'll throw open questions to the audience. What I would request is if you could introduce yourself as well as the organization you're from, if any. And if you have a question directed to a particular panelist, please let us know. Otherwise, you can direct them to me and I'll pass it on to the right person. We have, I think, about 20 minutes.
Yeah, perfectly fine.
Thanks for the opportunity. I'm Sai Shankar. I represent Apurlia Senior Care, startup from Chennai in senior related healthcare. The question is probably between Manav and Mr. Raja on from a regulatory standpoint. If there were top 2 things which you want a regulator to do to ease the whole process between the funds and the founders, what would that be?
Just to understand your question better, the top 2 things that we would like a regulator to do to ease the process between founders and the company. You mean between LPs and GPs or between the fund and the company?
Yeah, I think ideal situation is regulators have no role in this business. Ideally, they should stay away. I'll perhaps give you an example. Somewhere in late 90s, one of the first venture capital funds in this country, I think Indus Ventures, Mr. Thomas, former HUL head. He was in a panel. I was a regional director of SEBI. I was a bureaucrat. I think, bureaucratic mind is everything you have to regulate, and that is where you come from, right? And so those days we were debating, whether VC capital need to be regulated or not. And in an open panel, he was so clear in his mind. And also he was a little surprised and strange. Are you sure? Who asked you to regulate? Is it possible to protect an investor here? So those kind of questions. Right? So it took so many years for me to realize that now I am with him to say that this is not an asset class where you can really protect an investor. Okay, they have already decided to take extreme risk. So this is a business asset class where ventures fail in large numbers. Okay, and this is an asset class where VCs fail in large numbers. The success rate of VCs is 10%, and 2% of the VCs generate 90% of the superior returns. That is the game in the US. More or less it is going to be here. And we are talking about 1400 AIFs. So let there be, we are nobody to say how many should be there. But when it comes to success, there will be a massive correction here. So I would like to say how difficult it is. I was a regulator once. In the case of all mutual funds, in the case of other pooled vehicles, there is a small investor involved. There is a responsibility for the regulator to protect them. Here, it is such a dynamic business by operation For example, let us say we value our assets every year. That valuation has no meaning. Because next year my companies go through down round and the earlier valuation has completely gone, And similarly, the way the investors together change the game with the founders, they keep merging and demerging, okay, and the acquisition is a normal game, so very, very complex. And similarly, if LPs want to hold the assets for a longer time, where is the need to say that it has to be closed by a certain time? Because it is LPs capital, and LPs want to stay with the manager. So it is a private affair between the LP and GP, and that's the way it has been working. But having said that, I'll state to your answer, globally there are 300 to 400 typical LPs, and they are members of ILPA, International Limited Partner Association. The ILPA's stipulations, ILPA's detail-oriented norms are so apt and so stringent, and they figured out over a 60 years period how to manage their managers. Okay, and our regulators' stipulations cannot be superior to that, right? And all these guys are members of ILPA, and they have been managing their GPs. They're super smart, and they have the power. In our asset class, the LPs hold the reins. They have the power to change the GP anytime. Okay, and it works perfectly well. And they give the freedom where it is required. They hold back where it is not required. So I feel we have to go back to light touch. And investors should not expect any protection. It is not possible to protect.
I just want to add one thing. I agree that some of these things need not be regulated, but if there is regulation, the one thing that we all who work on these regulations would like to say is just predictability. No policy flip-flops. There's an evolution thing, nothing reactionary.
I'd just like to add one thing. There's very interesting observation in the budget which the finance minister made about variable capital companies coming in. And if you say essentially, evolving into different categories, right? Saying, listen, if AIFs are becoming more legalized and studies would push through more standardization, I think most people agree it's kind of avoidable from a GP perspective and LP perspective, but if that's coming, you say, but create more frameworks for flexibility, because the market is so flexible, every deal is specific. So at times a transaction, right, going back to your question, may not fit in a typical fund structure, but there is a very important role that the GP plays. And the GP is able to identify, listen, I have 100 investors, but 2 of these or 3 of these could come in different varying risks. And so you can manage risk and reward in a structure which fits in the local regulation framework, is regulated, because there is always value for regulation, because you need tax pass-throughs, you need other frameworks, etc. But saying, listen, this doesn't need to sit within my fund, it can sit elsewhere. In the current framework, collective investment schemes, will probably get shut down, as I said. And that is allowed in most parts of the world. Do it in a nice regulated manner. And I think if the VCCs kind of come up in the manner it has the potential to, it could open up large pools of capital for managing these specific risks and rewards.
I think one other thing that we keep hearing foreign investors in India, and where I think we need to see one regulation is, again to take up on what you said, ease of shutting down. It is so complicated today to shut down a venture. The easiest thing is to find a solution to probably buy it for $1 or something like that, right? But in other economies of the world, it's as easy to shut down as it is to start up, because it is, as all of you have said, part of the venture capital thing, right? There are companies that get invested, there are companies that get invested into exceedingly well, but there are companies that either don't get invested at all or post-investment need to shut down. So, to enable that part of the process as well. Anyone?
Before I tell about myself, I want a fresh take on something. Firstly, an amazing panel gathered with such a diverse experience set. My question is, I want a fresh take on something. One of the data that US enjoys over the rest of the world is the top quartile, that 0.001% entrepreneurs and talent that they have. Right? That's rest of the world combined, they have more entrepreneurs within that own country and within the two east and west coasts. What is that delta that maybe India needs or should have to truly grasp the opportunity that is actually in front of us in this decade that's in front of us? I am Shishir. I'm a marketer turned PE enthusiast trying to scale private equity and launching my first fund called Possible Money Capital.
Do you have a question to anyone in particular?
So it's open to all four because there's a PE, VC operator as well as an amazing SaaS entrepreneur in front of us within the fraternity. Just a fresh thought or something like
If
this.
I could request Ritesh to take this first, please.
Shishir, right? Shishir, unfortunately, it's not easy to create that ecosystem because a large number of factors need to come together. So there isn't like a switch that you can flick or a switch that the government can flick to make it happen and make Bangalore equivalent to Silicon Valley in the next 10 years. It's not going to happen. It's just a long, hard road, but it starts, I think, with human capital. It starts with talented entrepreneurs. Next comes risk capital to enable those entrepreneurs. Next comes, I would say, government support to startups as well as to the capital that enables those startups. Followed by public markets that accept those companies as they grow up. And I think we are right at the beginning of the journey. I don't think, in forums like this, we like to beat our chests a little bit as to how much our startup ecosystem has grown. The fact is that our startup ecosystem is tiny. The cumulative market cap of all our startups put together is probably of the order of magnitude of $100 billion. It is tiny, and so we need to put our heads down and make sure that each of those things, and I forgot to include even physical infrastructure, digital infrastructure, all of those problems need to be solved. But I think it all starts from human capital, and that is why all of us are obviously very bullish on India getting there, because that first factor exists in India in large quantities.
So again, like Ritesh has, I think, covered a lot of ground. So yes, the ecosystem is very, very important. Like simple things on infrastructure, like being able to have, like, say, 8 or 10 meetings in a day requires you to have predictability of traffic, right? Like if you want to have like 10 meetings in a day in Bangalore, it's like literally impossible. Now that's the human connectivity we require in terms of like the ecosystem, that like you are able to meet like all the ecosystem stakeholders very, very quickly. The ideas get fertilized very quickly, and they are able to capital gets deployed behind those ideas very quickly. That's how the ecosystem gets built. I think we have done a great job in terms of SaaS ecosystem. We've done a great job in terms of B2C ecosystem, in terms of hardware ecosystem, and the AI ecosystem. So, like, every ecosystem needs to be built.
Am I correct in saying that there is no one fix, but you deal it sector specific, like you said, SaaS and different things?
So there are quite a few sector specific things. Like we've done great on software side of things. Like we need to do like really great on the hard side of things as well.
Time for one more question.
There was one at the back, and then there was one.
Hi, my name is Rahul. I'm from Prime Securities. We are an investment bank raising capital for startups doing M&A. Firstly, thank you to a very elegant panel for a great discussion. I know there's enough discussed about SME IPO and capital raised through that, but I just wanted to understand your views on where we stand now, where is it evolving as a source of capital and as a method to SME. And would it be possible for an SME to later raise capital from the larger bosses once it's already raised money from the SME exchange? And this question is for anyone.
Yeah. India has been, at the policy support level, has been aware of need for a SME platform, and many attempts unfortunately made by regulators have not fructified. I used to be on the board of OTC exchange in the olden days, right? So last 2 decades, many efforts have been made, but thanks to BSE and NSE platforms, and there has been some action there, and so if, to me, we need to really make SME platforms more transparent, more reliable, and that could be the best avenue for realizing exits for the VCPs. And today, the biggest issue with SME listing is lack of liquidity, and reasonably high amount of diligence is required. Better merchant bankers have to take up. I have a feeling threshold has to be raised, and so that the medium level, because why threshold has to be raised? Because the main board, unless you have $500 million or 3,000 crores plus market cap, you will not be able to make a good IPO exit. So then the gap is very wide, and so SME platform has to be. I have a feeling already there is a discussion happening. A lot of, the unusual rise in prices in SME listed companies is creating alarm. And interesting stories, I think some auto repair wala prepared a IPO and it got oversubscribed, and this typically happens in hybrid markets, and the regulators can't do it. Markets have to change it, because regulators had few more risk factors. As a regulator, I remember one issue we added 13 risk factors, and that got oversubscribed 13 times. So this is a typical symptom of the bull markets, and so SME market coming back, and it is a great place, and for the VCPs to realize exits. I think a lot of reform required there, and more interesting. Type A bunch of merchant bankers, they completely ignore SME because they don't have much fee there. You said you're an iBanker, and so the best iBankers backed with the good HNIs who can underwrite issues. They have to jump in and they have to bring more transparency there.
No, I'm mindful of time, so there was one other hand. Okay, so we'll take just one question.
Yeah, one question.
Decide, and I'm going to play referee here, so I'm going to request both the questioner as well as the response to be very short, please.
Yes, my name is Siddharth. So I think the panel briefly touched upon the importance of getting money in the bank as soon as possible for an early stage startup. So I just wanted to understand what are the barriers for technology adoption amongst VCs and PEs, say technologies like AI or blockchain that might potentially decrease this time and increase efficiency in the process.
I'm going to pass this on to the far end of the panel because both of them do this every day. So first Asan and then the final word to Tarun.
Good question. I ask my clients this almost every day, prospective clients. But I think I think it's an evolving space, and I think a lot of the technologies specifically made, because it's a very nuanced segment, right? I mean, the PVC world itself, or the transaction, every deal is different, every fund structure is different. So technology frameworks have also not really kind of scaled up till now, right? I think they started to come in. So there is a lot of focus. We're seeing funds like that. I think one thing it will be required, it is a digital transformation, and it needs a mindset starting right from the fund. I think technology adoption needs to be a conversation amongst the investment committees that on a regular basis of what can we do to make things better. And for sure, I think it will follow in an organic manner where it is relevant.
From at least in the public markets, we need to become much faster. So there used to be a concept of postal ballot. Now that's doesn't happen postally anymore. It all happens online. But the timelines are still designed for the postal ballot. So we are still looking at 21 days kind of processes. which could be shortened from a regulatory perspective to like 7 days. So I think like it is also important that like regulation keeps up with technology that already is there. We are not even talking about like applying new technology over here.
Thank you. And Arun, I don't know if you have any final words, but if not, I'd really like to thank the panelists for taking time on a weekday to join us and to share their thoughts and to answer the questions. Thank you so much.
Thank you.
Thanks for an insightful session. I would request the panelists for a group picture.
Probably step up. Thank you.
Our next session is on focus on growth capital. We can get back after a short networking break at 12.